Hi guys, it's Anne-Marie. I just wanted to come on really quickly and talk to you about the rates going up, which you may have heard on the news. Funny enough, I had lunch with a longtime lender of mine. We're talking about some strategies with our clients, and I said it's funny the rates, the feds have raised the rates again, and people tend to think that means mortgages. And when I came back from lunch, one of my clients called and said, "We're just going to put our home search on hold because the rates went up." So I just want to take a minute just to talk to you about that. So when the Fed raised the rates, which happened this week again, that affects short-term loans. So things like car loans or credit cards or your home equity lines. But when we're talking about mortgage, you're talking about a long-term loan. And that is affected by the treasury bills, the 10-year treasury bills. So when those do well, mortgage rates do well. And that's what you actually want to watch. So what happened was this week when the feds raised the rate, the mortgage rates ended up going down this week. So he said he quoted someone, this person obviously had good credit. This was a really good rate, but it was like 5.25, I think he said. Overall, the rates went down anywhere from a quarter to a half, mortgage rates. And the way that would be determined is what your credit score is, what kind of loan program it is, and other things like that. But the point is that the perception that when the feds raise the rate, everyone assumes that's mortgages too. So I hope that brings some clarity. Just to put that in perspective, the T-bill, the Treasury T-bill, in June, I think was 3.6, and now it's at 2.6. So rates are doing good. They're doing okay. They've gone up, but we all know they were kind of held down historically low, kind of falsely, right? So historically over time, we're still at rates that are lower than the historical average. So the moral of the story there is if you can afford the monthly payment, it's certainly much better to pay your mortgage than somebody else's. And, since home ownership is where most of us really gain our wealth because we're just living in a place, well, it hopefully builds some equity for us. It's always prudent to try to get yourself into something that's affordable. And then you just let appreciation do its thing. Now we are in a lowercase recession, which is nothing like the big one that we had 10, 12, whatever years ago it was. That in that situation, we didn't have a lot of equity in the market. There was all those crazy loans where people were just doing 100% financing. They were doing negative amortization loans. They were doing interest-only loans. So there was nothing to sustain a down market. Now, what happened was in that time when people that had lived in their homes and they could afford their monthly payment, they just rode out that storm. And then on the other side of it, their prices started to go up pretty quickly. And of course, now it's ridiculous how high they've gone up. So if for now, if you can afford that monthly payment, and that would be determined by what is your interest rate, what is your down payment, and what is the purchase price of the home. So that would be what you want to focus on. Now, in terms of like the market conditions, we are seeing a shift. I think I've been talking about my realtor friends across the country, but it's not necessarily predicted to be a crash. What they're saying is, and I'm going to put a link at the bottom to Brian Buffini is my business coach. He's a phenomenal guy. And he had Lawrence Yun on talking a few weeks ago, who's the chief economist for NAR. So he can explain this far better than me. But the gist of it is we still have an inventory shortage. We got behind by 10 million units during the Great Recession, and we've never caught up. So whether you're renting or whether you're looking for a home, there are less properties available than people that need to be in them. So that makes it still a seller's market. So that means that we're not going to have, they predict they're not going to have a crash. Now, there are some buyers that have been sidelined because the rates did push some of them out of the market, especially the first-time home buyers that were in California, which is expensive. But what they're predicting is next year, the prices will be a little flatter, single digits. This is national. And that rather than maybe 20 offers on a property, there'll be 3. And that rather than paying 100,000 over asking, maybe now you pay list price or you pay a little bit over. So if you're selling a home, we're going to have to be very strategic about pricing and also setting up clients and educating them with proper expectations, because there are sellers now that think they can put their home on a Thursday and on the market and be sold by Monday, and they're freaking out that it hasn't happened. And I mean, that was crazy. And if you've been in the market shopping, it's been freaking nuts the past 2 years. So in a way, it's going to be more normal, still a seller's market, but like hopefully the pace will slow down a little bit, and sellers can, I mean, buyers can start negotiating a little bit and asking for repairs and keeping their appraisal contingencies in place. So I just wanted to come on and just sort of hopefully calm some nerves or some misinterpretations of what's going on. I'm also posting a little infographic below that kind of explains the dynamics between 2008 and now, because it's very different, very different. There's trillions of dollars of equity in the market. And, you know, again, over time, historically, homes go up. Now, there might be a little bit of a dip throughout that overall increase in curve, but the dips, you know, are only on paper if you're living in there and you can afford the monthly payment. So I'm thinking too, depending on what your situation is for selling, some sellers have just been sitting on the sidelines because they've been making so much money in appreciation. I mean, 20, 30 plus, gains every year, the last couple of years. So if there's someone that's maybe been like, especially investors that maybe have another property that maybe they want to unload it, or they've been looking to do something else with their money or roll into something else. I mean, if it's going to start flattening, it might be a good time to start thinking about selling. And also if you were concerned about, what you could buy if you sold, again, that's softening. So we're already seeing this. We're already seeing a little bit more inventory coming on the market. We're already seeing definitely a slowdown, like definitely it's interesting, but it's not, they don't predict it to be a crash. Now, that's a prediction. So I hope this helps a little bit. I just want to kind of make sure, it took me, when I first got in the business, a long time to figure out this whole rate thing. And I was an English major, so it took me a while to figure out how the finances work, but rest assured, rates are still healthy. They're in the fives. And the market conditions are really good. Job markets are good. You'll see in this infographic. So if you have any questions about that, give me a call. We can talk about it. We can look at your individual situation. But I just wanted you to have some knowledge so that at least when you're hearing things on the news, you could kind of sort that through in your head and understand what that really means. So happy to serve you any way I can. That's it. So hope you guys are having a great weekend, and we'll talk soon. Take care.